All right, thanks for joining me tonight. My name is Christian Fromhertz. I am the CEO and founder of Tribeca Trade Group. Tonight, we're going to be talking about pairs trading, why I'm looking at pairs trading in this type of environment. And also, in the beginning of these webinars, I usually give a quick macro review. That is what we do all day is, take a look at what the markets are doing. So always nice to take a quick step back while we're not watching for trade flow and not watching for signals, just to kind of see where we are, what's been going on, what kind of trends are in the marketplace. So I'll go through that for about 10 minutes, and then we'll get into the subject matter of tonight's webinar, which is pair trading. So thank you again for joining me tonight. And let me go ahead and read the risk disclaimer. Day trading, short-term trading, options trading, and futures trading are extremely risky undertakings. They generally are not appropriate for someone with limited capital, little or no trading experience, and/or low tolerance for risk. Never execute a trade unless you can afford to or are prepared to lose your entire investment. All trading operations involve serious risks, and you can lose your entire investment. No trades are recommendations or advice, and we cannot be sued for losses of capital. All trades are for educational purposes only. Contact your broker or RA for execution, margin, and other capital requirements. Everyone watching presentation adheres to all disclaimers on www.tribecatradegroup.com. Okay. So quickly about myself, most of you I see in the room are members of Tribeca Trade Group, so you know me well. But my style of trading is, I would call it macroeconomic, macroeconomic style. That's certainly what I've done in my institutional trading career as well. I was a senior trader for Bank of America Merrill Lynch on the Delta One space and ETF space. So if you know ETFs at all, you know that they cover every nook and cranny of the universe. So they cover, of course, equities. That was where they were first popular. Then they also not only domestic equities, but international equities became very big. Then you have fixed income equities. You have commodity ETFs, which are very popular now as well. And what am I leaving out here? Commodity ETFs as well as currency ETFs are in there as well. So my career, I started off at Morgan Stanley as a financial advisor, then moved over to Merrill Lynch. Like I said, started on the Delta One desk, worked my way up through there, ran a couple different programs there, including customized indices, allowing institutional investors to create their own customized ETF. That later grew, that was all on the swap platform. I later grew to trade ETFs and became a senior ETF trader there. My Twitter handle is @CFromhertz. You can contact me there. I'm also from New Jersey. I have my MBA at Rutgers University. So let me go ahead and so that is me. And I live in New York City. I live right outside of Tribeca, Battery Park. Some consider that Tribeca, but it's essentially Battery Park, New York City. That is my beautiful view. And so just wanted to talk about what we've been seeing lately. You know, the SPX continues to be resilient. It continues to be a bend but don't break type market. Every time we seem to want to go a little bit lower or there's trouble on the horizon, something seems to kind of save the market, whether it be a push out of rate hikes to a further time horizon. Janet Yellen has been very dovish. And we've had one rate hike, just 25 basis points. You saw what that did to the market towards the end of 2015, beginning of 2016. While I thought that a quarter of a basis point hike is very minimal, nothing much to see there, but it did bring some volatility to our market. So I think the Fed is being very gentle in terms of when the next rate hike is coming. We did get a little bit of volatility based on a couple of the Fed speakers talking about, hey, there still could be some Fed rate hikes on the horizon this year. So also we've seen oil rally, which has really helped the S&P. What I've been looking at in terms of charts, and I'm going to bounce around through charts in the presentation, but if you look at the daily chart in S&P futures, we continue very similar to. Let me just blow this up a little bit. Very similar to what we saw a couple weeks ago. We do not want to get below. Apparently, we really don't want to get below the value area here on the daily chart. A couple weeks ago, or actually, I guess this is the beginning of April, we came close to breaking down here. A lot of people are seeing a possible head and shoulders, left shoulder, head, and right shoulder. When we're on this left shoulder, if that is the pattern that's playing out here, we never really broke down here on this left shoulder. We almost broke into value several times here. You can see these wicks. Intraday price action got into there, but we never actually fell. We are seeing this a little bit different in terms of technicals here. Again, we're almost breaking down. We've almost broken down here. What, about 5 different times here? But we have not broken down below that green line, which is what I keep referencing as in S&P futures. What is this? 2041.75 is a level that I keep referencing. So 2041.75, that's the level that I'm watching. However, we are seeing things like, we didn't see this on the, I'll reference this again as the left shoulder, even though we don't know if this is a head and shoulders pattern yet, but we did not see a crossover in the moving averages. This is the 5-20 exponential. The yellow line is the 5-period exponential moving average. The blue is the 20-period exponential moving average. We did not see that crossover until recently. So, for some people that is a trend change. So where I find this particularly interesting and a little bit of a tell that took place today, very similar looking chart in IWM, except IWM did break the value area today, as well as this moving average crossover here. So that's a couple things that I'm looking at in terms of the major indices. Also in terms, I also very much will look at different parts of the world. If it's China, if it's Japan, whether it's Europe, if those are breaking down, that often leads to contagion into our markets. I also very much look at sectors. What's performed really well? Retail had a big move up in from the February lows, and was one of the strongest sectors. But we've kind of seen this group break down twice now. And the other area that's broken down that I see on my charts is technology, as well as semiconductors. Just to give you a little visualization, XRT, which is often a gauge of the consumer and consumer spending. While I know everybody is fixated on the change in trend, and Amazon has been very strong, XRT had the breakdown, which is a good representation of the whole sector. It's an equally weighted ETF. Notice, however, we're all the way back to this level where we were back in February. So quite different looking chart than the S&P and even small caps. Note we are getting a little bit oversold on retail. Also, you could see SMH has had a deeper of a sell-off than the overall market as well. So semis have been weak. They tend to follow Apple sometimes. If we look at the chart of Apple, we have certainly broken down there. We're past the February lows as well. Yes, no, we try to start. We try to start the webinars on time, give a couple minutes to people running in, but I never like to start a webinar, 5 or 10 minutes late. So by any means, ask questions, throughout tonight's webinar. The webinar is, of course, education. So the more questions you ask, the more you guys will get out of it. So by all means, ask away any types of questions, even through the macro recap that I'm doing right now. I'm happy to do that. So sectors that I have on my watch list, I actually drew this up yesterday. A little bit different today. We saw a lot of the defensives crater today a bit. The talk of possible rate hikes kind of sent all the hiding places where people have been searching for yield into a tailspin. We saw consumer staples break down. We saw utilities. All of these were down around 2% today. What was the third area? Telecom was also very weak, and REITs were also weak. So all those defensive groups that I think, my opinion, that we've gotten a little bit overcrowded. Investors have flocked to those areas seeking yield, and also to try to avoid, coming volatility in the market. Those areas got squashed today. Where I'm watching in terms of sectors that I am bearish on right now. Small caps, I've talked about them. They look weaker than the large caps right now. Financials, that may change a little bit depending on what happens with the Fed minutes tomorrow. But right now, I'm pretty bearish financials, as well as in the industrial space. The industrial space very affected by the U.S. dollar. I'll change my opinion if we start to see a weaker dollar again, but right now we've seen a nice bounce in that, and we're back in that sideways range with the U.S. dollar. Sectors, groups that are on my bull list, we were talking today in the trading room, not a ton of areas that I'm really bullish on right now. I do like agriculture names. I like the commodity futures themselves. You can access this through the DBA ETF. I'll put that in the chat. That is the DBA ETF. So that looks at soybeans, cotton, sugar, coffee, those types of things. Those have had a nice little rally, a little bit different. Again, like I said, I'm going to bounce around through a couple different charts. Best visualization I can give. One thing that's been, I was looking at copper a couple weeks ago. Copper failed to continue with the rally. So once it tried to get into this weekly chart value area, it stalled out. But what's a little bit different is, not every commodity is doing that. If you look at the DBA ETF, it is starting to get into the value area. So just coming across value, it has the same type of rally since the February lows, but a little bit more carry through. It looks like in the DBA ETF. Again, that's the agriculture ETF. Other areas that I like, gold miners. You can look at these charts as well. Pretty nice looking trend right now. It did actually hit this version point of control, so pretty interesting there. That's when it backed off. However, I do like this sector for longer term. The other area that I like is Treasury tips. Treasury inflation protected securities. There is an ETF that you can play in this space. That's TIP. We just saw the CPI Consumer Price Index come out today, which was a little bit of an uptick. I've also been seeing inflows going into this particular ETF. So pretty strong looking chart. Looks very similar to GDX. So kind of a little bit of a comparison there. What's driving GDX? Well, a couple different things, but could be an uptick in inflation as well. So those are areas on, again, I always like to, give you a little bit of some trade ideas, what I'm looking at. So those are a couple bearish sectors and a couple bullish sectors that I have on my radar. Recent trends in ETFs during the last month. If you guys follow me on Twitter, you know that every day I'll put out ETF fund flows. Someone just asked me about that. They said, "Why do you look at fund flows? What is the takeaway from looking at fund flows?" Well, it really, what I'm looking at is a couple different things. I'm looking for where the big money is going. Where are they positioning themselves? What are they getting out of? ETFs are a little bit different. When you follow this cash action in ETF fund flows, it's a little bit different than options. Options, a lot of times, it could be a quick move that people are playing. The ETFs are more of a trend, and I'm trying to pick up trends such as I did in gold. Gold has seen the biggest inflows of any ETF, that particular group, than any space in the ETF. So we saw that in the beginning of the year. That's what really compelled me to go long gold in the beginning of the year. What have we seen in the last month? We've seen a lot of outflows coming out of equities. So, it's also a gauge of sentiment. I'm looking for, what is everybody doing? Is there a little bit of fear in the market? Are people taking money out of the market? Are they putting it more into cash? Are they putting it into cash equivalents, like things like SHY, BIL, which is T-bills? You'll see that funds do that from time to time when there's a little bit of volatility, when people get a little frightened. We have not seen that yet. However, we have seen a lot of equity outflows this month. We've seen that's actually $5 billion. That's not 0.5, that's $5 billion coming out of the SPY ETF. That's over the last month. Same thing with Qs, $2.4 billion have come out of that ETF. EZU, which is Europe, $1.6 billion. I think just 2 weeks ago, it was roughly $15 billion came out of equity ETFs in 1 week. So that's the type of thing that I'm looking for. And then I'm looking for on the flip side, okay, well, if they're taking that money out, what are they putting that money into? And it's gotten very defensive. Gold has seen inflows all year long. long, but it continues. We haven't really seen a drop off. One thing I've also noticed is whenever gold gets a little bit weak, people start to add money back into it. Yeah, and it helps to create a bias, as well as, sometimes things get overbought and oversold as well. It's a good example of, what happened with utilities today and what happened with consumer staples. Those are two of the equity sectors that I've seen a lot of inflows, as well as REITs. So those can get overcrowded, and you want to be aware of that. You want to stick with the trend, but you also want to be aware of, when these guys start to take their foot off the pedal in terms of buying. Sometimes that could lead to a little bit of pullback in these groups. So just to kind of finish this, the other trends that we've seen money going into has been going into bonds. I mentioned the TIP ETF, Treasury inflation protection, that actually has seen $828 million, and that's new. I haven't seen many inflows in that all year until the last month. So that's pretty new. I also have REITs in there. REITs for the last week added about $800 million going into that, but they do look a bit overbought. So some things on my radar: we have a G7 meeting later in the week. We have not Fed Fund. We have Fed minutes that are coming out tomorrow. We have, so other areas that I'm watching besides events: Fed Fund futures. I want to keep an eye on what they're implying for June. I didn't check it today, but going into today, it was about a 5% probability that they're going to raise rates in June. The first time I see a 10 bip move, that's not out until I think October, the Fed funds rate from current levels. What I've also been watching is the Baltic Dry Index. That's been a really good indication of economic activity in the marketplace. So I'll look at that every day. It did tail off the last couple of weeks, but then rose the last 2 days. So something to take a look at. I think I have all my Bloomberg charts being used right now. Let's see if I have one more. Actually, I can use one, but really interesting is this Baltic Dry Index. So that's something that I look at every day. And you can see, if you actually put this together with, let's just add SPY in here. And let's take these out. And you can see it's got a pretty good relationship over the last 6 months. So the Baltic Dry Index really sold off or hit a low in February. That coincided with the S&P low, and then also it's been rising very nicely, and the S&P has been doing the same, and then it's been starting to trail off, like I said, the last couple of weeks. So something to keep an eye on. It's got a pretty nice correlation and a pretty nice fit. So Rick asks, how does the money flow correlate with an oscillator like Chaikin money flow? A little bit different. The Chaikin money flow kind of uses some assumptions. I've used it before. It's not one of my favorite indicators, I will say. It tries to look at make assumptions about, I believe, money volume volume going up on up days and vice versa. So it doesn't, the Chaikin money flow, it doesn't actually look at money flows. It looks at volume in relation to when names are going up versus down. So, and then they're making an assumption about money going into stocks and money going out. The inflows and outflows that I'm looking at in ETF, those are real concrete flows. That is tracked by Bloomberg. Also, like Lipper tracks these numbers as well. This is actually money. This is real creations and redemptions going in and out of ETFs. So much different than the Chaikin money flow, which is using assumptions based on what volume is doing and advancing and declining issues. So what else am I watching? Of course, there's been, everybody's kind of been watching or in tune to the move in oil with equities. I think that correlation is breaking down a little bit. I tend to think that when volatility gets very high in commodities or currencies, that's when the equities, when the correlation really starts to move. I think volatility has slowly been coming down in crude oil, and that is why I think equities are starting to detach from what the move is in crude. I mean, it's over time there hasn't been a big relationship between oil and equities, but over small time frames, especially when volatility is high, we saw this with the dollar too. If you remember in the beginning of 2015, when the dollar was really getting stronger and stronger, you saw a big correlation with what the U.S. dollar was doing with what equities is doing. Now, over time, that correlation separates because that doesn't really have a strong relationship over the long term. But when volatility is high in one of these areas, then it really starts to spill over to the equity market, and that's basically my opinion and what I've noticed over time. Other areas that I'm watching: gold, copper, and agriculture, which I talked about some of those sectors that I'm watching. So anybody have any questions? So that's my little macro recap. Some of the things that I'm watching right now. I can go into detail about any more of these things. If not, we'll go into pairs trading and why I'm looking at pairs trading right now. Okay, cool. Okay, so pairs trading. So what is pairs trading? Just to start off with, it's a market neutral strategy. It reduces directional exposure. Why would I want to do this type of strategy? And this was from yesterday. I think the S&P is now flat for the year to date. So number one, if you look, obviously there's been volatility throughout the beginning of the year, but just looking at straight performance, the S&P is flat right now. Some people are expecting a possible drop. We talked about the head and shoulders pattern that's in the SPY that everybody is quoting now on media as well as on Twitter. So it seems to be everybody is expecting somewhat of a drop. Not everyone, but the bears are expecting a drop in the market. Other factors to consider. The sell in May and go away. We have seen a little bit of volatility pick up. As I mentioned, we've seen a lot of equity outflows in the week leading up to May. So it does seem like there's some things that are changing a little bit in the marketplace. So if you don't want that exposure of going straight long something or straight short, what you can do is a market neutral strategy. You're essentially going long one thing and going short another. Those things could be, so you're taking away your market risk. When you do something like long and short, you're reducing that relationship. So you're buffered by not having the market go up and or the market going down and losing money if you're long. There's several different ways to accomplish this. You can go straight, long one stock, short another. Like we've been seeing, long Amazon, and you can go short. A retail name, you can go short something like Macy's. You can go short something like Gap, which is really obviously that type of trade has really outperformed. You can do this via stock versus sector. So you can use a sector ETF. So sticking with the Amazon example, considering that's worked really well in the last month, you could go long Amazon and you can go short either XLY, the consumer discretionary ETF, or you can go long XRT, which is the equally weighted retail ETF. You can also do this sector by sector, and you can go if you think that there's relative outperformance in one particular group, and just to define the pairs trading again. Basically, I'm looking for outperformance. Pairs trading can be a lot of different things, but in my pairs trading, what I'm looking for is outperformance from one group or one equity to outperform the other. So you could do this sector by sector. If you think that there's a bias that the tape will be defensive for the rest of the year, you can go something like long consumer staples versus short consumer discretionary. You can also use these to play a reversion, and I'm going to give you a couple examples of these in the charts as well. So you can play when something gets a little bit extended. I looked at this relationship about, I'd say, 2 months ago, when the S&P was continuing to go higher and higher, and the developed international markets were going lower and lower. Well, this really got to an extreme, and I talked about that trade. I issued a trade idea in Trader Planet. I talked about that in the trading room as well. And what I was looking at was going long DBEF, which is developed international markets, so essentially Japan and a lot of Europe, hedged the currency, hedged in that trade, and going short SPY. So I'll bring up that trade. I'll show you that trade. That was a good example of a reversion trade where the USA was just dominating a little bit too much in the short term. So I wanted to include some examples, just straight out year-to-date performance. Yeah, I'm going to go into a couple examples of some areas that I like right now. So just to give you an example, how things have worked. If you went, these are pretty extreme examples. The long miners and short gold. Gold is up. I'm probably going to misquote I think 20% year to date. However, the long gold miners short gold trade has worked really well. That's up 60%, as I believe gold miners are up 80% year to date. I have to double check that. I'm just going off the top of my head. Long utility, short biotech. Why I have those, I didn't pick those out of a hat. The long utility, short biotech. We saw a huge unwind of a trade that happened in the beginning of the year. This is a perfect reason why I track fund flows. When you see something like, whoops, here was a good example of a rotation. FBT. First of all, what is FBT? Let me just take a step back. This is a particular ETF that I pick up. I pick up all the ETFs in the world that, and I monitor these in terms of fund flows. So this is one particular ETF that for whatever reason one fund was using. This is the First Trust Biotech Fund. Some of you may have heard of it, some of you not. But in any event, this is one ETF that we saw a massive unwind in the beginning of the year. This definitely contributed to some of the volatility in the beginning of the year. So this is the outstanding shares. All this buildup of investing into biotech over the last couple of years. Well, this is often how hedge funds trade, is that they'll slowly accumulate a trade over time. And then as soon as it hits the radar that they want to get out of a trade, and what you're looking at is the outstanding shares, so the investment going into the fund. And then all of a sudden, they in about a week or two, they really hit the brakes and sold out of this particular fund. So what did they do if they went out of biotech? I hope I have the right symbol, but I think it's FXU. So this is the First Trust Utilities Fund. And you can see quite the opposite. So, not much of a change in outstanding shares. All of a sudden, until January, they started to really invest and go long utilities. So looking at that, and you could basically see that, you can monitor that as I was doing every day. Money, every day I'm like, there's $500 million coming out of biotech, $500 million going into utilities. So this went on for some time, for about a couple weeks, maybe a little bit longer. So if you look at that trade earned 39% if you would have did what they did. Just a couple examples of going long stock versus the sector. NVIDIA, which I like, has been a serial outperformer. That's up 27% year to date. And Amazon, the example that we used in the beginning, long Amazon versus short retail year to date, up 10%. Probably that's a little bit more if you would have just done that trade in the last month. So the one example of the reversion trade, which I'm just going to show you guys quickly. This is the SPY versus DBF. This is, on Bloomberg, you can do this. You can monitor sector by sector. You can put together a ratio spread and take a look at that. And, this is what I was looking at, where this got very overbought. You can actually put an RSI on this particular ratio, and you can see that SPY versus international markets, Europe, they got pretty overbought. Since then, this was, when was this? The beginning of April, and that's come in pretty hard, that particular spread. So that trade worked out pretty nicely. So what is the best way to accomplish this? If you're a hedge fund, if you're a big institution, they'll essentially can do this in cash. They'll go long gold miners, and they're short gold, or any one of these examples. They can go ahead and easily go long. To go short, they call up the broker. They ask for a locate. Can I go ahead and short this? What's the rate? Is it hard to borrow? Yes, no. What is the rate? Something like gold, probably no charge to go short gold. Something like biotech, yeah, probably about 1% or 2% that they would get charged for going short to execute that trade. But in any event, they can do that in their prime brokerage account. How can retail do that? It's a little bit more difficult. You can do that. It's going to cost you margin. You are going to get charged for that. It's a little bit different. And also, keep in mind when a hedge fund is doing this, they're doing this $20 million aside. They're doing this, or $5 million long versus short. This is a strategy that I used to do when I was at Merrill Lynch and Bank of America. We used to have a kind of a pairs trading book where I would look for outperformance ideas such as these, and I would do $5 million or $10 million aside was my usual side to do this type of transaction to get a legitimate size gain in that. So one way you can do it is in options. However, it becomes a little bit hairy with options. The problems, buying a call and straight out buying a put, they can be expensive. So, going back to these examples, buying a call in utilities and buying a put in biotech, you're paying premium on both sides of that. So that could be a little bit of a cost, and especially if the trade doesn't work. If your timing is a little bit off, you're going to lose on it basically if the ratio doesn't go anywhere. Oops, there we go. And also, if they both go up together, the cost of the put is going to eat into your cost of your profits on the call side. So one way that you can structure this trade, so I know we're kind of going over a couple different concepts here. We're kind of going pretty in depth in here. But one of the strategies that I like to play best in this type of trade is using what's called branching off from a risk reversal. Anybody know before you look at this slide, what is a risk reversal? Does anybody know what a risk reversal is in the room? Yeah, essentially selling a put and buying calls. So what you could do with this, yeah, and it's a strategy that Webb love to do. So I'm going to talk about a limited risk reversal. So first things first, what is a risk reversal? It's essentially trying to achieve being synthetically long stock through options. So you have unlimited upside, but you also have all that downside exposure. So when you do something like, and Lance said it perfectly, selling a put and buying a call, you have that unlimited upside because you're buying calls. However, if you're selling a put, if the stock goes down, you're going to lose just like you would on a stock, but more so because you're leveraged using a put option. Yeah, and vice versa, Rick says. That's perfect. So what is a limited risk reversal? Well, you're limiting, so that risk that you have in the case of a bullish risk reversal is when you're buying a call, you're selling a put. Your risk is that the stock, basically can essentially go down to zero or declines. So what you want to do is limit your risk a little bit using options. You're going to get charged a ton for margin by selling a put. So you want to try to avoid that. You also don't want to destroy your buying power. So what you could do is kind of structure this into what we call a limited risk reversal. You're limiting your risk. You're buying in this sense of a bullish position. You're buying a call and you're selling a put. Excuse me, you're selling a put spread. So you are limiting your downside to the width of the put spread that you're doing. And same thing, on the short side, if you want to go short, you're buying a put And instead of selling a call, which gives you unlimited risk, you're selling a call spread. So you're defining your risk. Your risk is limited. So this was very much Webb the goals strategy that he'd like to do very much. I did contribute, and I coined the name limited risk reversal. I think that's the best way to describe it. And this spread offsets the cost. So, keep in mind that, when you buy a call, when you buy a put, and that's the problem with the pairs trading an option, is you're spending a lot of premium. So by selling the put spread, selling the call spread in conjunction, you're going to offset your cost. Okay, so someone asked before, I think Greg asked, somebody asked, what are you looking at right now? Well, I'm going to bring up a chart. I'm going to bring up a chart of gold versus SPY. So this is more of a long-term play. I've got a chart up going back, what is this? Going back, 10 years? Almost 10 years. And you can see this relationship between gold and SPY. It's been in a pretty big decline since 2011. Of course, gold has been a huge topic. It's really been in the news the last couple months. So, it has gotten, I don't want to say it's an overcrowded trade, but if you look at the long-term relationship, it's just more widely known. So I won't call it overcrowded, but the gold trade, people are onto it. People are looking at it. Once CNBC starts talking about it, I hate when you're in a trade and CNBC starts talking about the trade, because sometimes the trade, can be essentially over. But I think the long-term relationship, I think there's something to do here. I think if you look at gold versus SPY over 2000, going back to 2011, it's been in this pretty big downtrend. So it may have some more room to run. It may revert a little bit more. So I do like going long right now, gold in short SPY. That is a trade that I like right now. And what you can do, so to structure this type of trade, so I gave an example of going out to January. This gets a little bit more expensive when you do something maybe 2 months out, just like when you buy calls or puts outright. Going out to January, you're going to spend some money. So what I was looking at is looking at the GLD leg first, which is in green. To go long gold, what I'm going to do is buy the January 130 calls for 460, and then sell a put spread against that. So I'm going to look at, and you can structure this any way you want to. You can do this so that your cost is close to your expense is close to zero. I'd like to have a little bit of bumper room in my limited risk reversals, so I go out of the money. So GLD, buying the 130 calls for 460, and I'm selling the near dated, the closer money strike, which is 121. And buying the 116 put. So you're going to collect $2.20 on that particular trade. So you're reducing your expense on the call side. Again, you could structure this any way you want to. You can, you can go closer. Where's gold trading now? Just to kind of foot this with a dollar amount, right at 122. So you could see I'm going out of the money. I'm going up to 130. And I'm not going right at the money. You can actually go in the money to reduce that more. However, you're taking on a little bit more risk because it's closer to the money. Same thing with the put side. You could buy the 195 puts in January. That's going to cost you 880. That has gone up recently because volatility jumped up a little bit today. And you can structure this again any way you want, but you can sell. One thing I was looking at was selling the the January 220. So you're selling this one and you're buying the 210 strike calls. Sorry, I'm saying that backwards. Bear with me, been a long day. You're selling the 210 calls and you're buying the 220 calls. That spread is going to earn you 417, and that's going to reduce your overall bearish play, your bearish put, your puts. So if you net these together, the pair trade, it's going to cost you $7 essentially, versus doing this outright with calls and puts, that would cost you $13. So essentially, you're reducing your premium, your cost by almost half. Again, you can structure this to make it a little bit cheaper. However, your risk is gonna go up a little bit. You're not giving yourself that bumper room. Oops, and I've got the wrong. That's going to be on the next slide. But the risk is that gold sells off and SPYs go up. So that's basically your risk. Keep the size small in these. This is not something that you need to do a 10 lot or 20 lot. You can accomplish this with just buying one or two of these, and you want to make sure that you know what your risk is on these. Your risk is that that the puts that SPY rallies and it goes through your strikes. Then the price of that is going to offset what you collected. So the most that you can lose on this is about $6, including the premium. Test. So that's the first trade. That is long gold, short SPY. Another trade that I like, this is doing a different method. This is going long a single name stock and going short a sector. Why I like this, what caught my attention in this particular trade, we saw this towards the end of last week. We saw some call buying going on in AGN, and we saw some put buying going up in XBI. So I kind of got the idea. I'm like, that's an interesting trade. I looked at the spread of these two. That's not it. Here we go. Nope, that's not it either. That's gold and SPY. This is another spread I was also looking at, TIP versus TLT. There we go. You can see basically that, let's take these out. You could see that Allergan has been underperforming Biotech essentially since the beginning of the year, had a big drop off. So I'm looking for this to kind of kick back up and for AGN to outperform XBI. I am using the option activity to, that gave me the trade idea, which often option activity does. And I'm going to execute this, in a little bit more near term. I'm not going out as far as I did in the GLD SPY trade. I'm just going out to June. And I'm doing this, structuring this a little bit different than a limited risk reversal. I'm throwing in another twist here. Instead of going outright long calls, just because the price of AGN is pretty expensive in calls, it's a high price stock, I'm going to do this via a call spread. And I actually put some signs in here just to give this a little bit better illustration. So essentially going long Allergan using the June 230, 240 call spreads, that's costing me $4.20. And then I'm going to sell a put spread against that. So I'm selling the 225s, buying the 215 puts, and that's going to earn me I'm going to collect $3.20 on that. And then on the other side of the pair, I'm going to go ahead and buy the XBI. That's the Biotech ETF. I'm going to buy the June put spread for $1.60. So I'm buying the 52, selling the 47. That's going to cost me $1.60. And on the other side of that, I'm selling the call spread. Any questions on this so far? I know this is kind of a complicated subject, but I think it's, I want to give you guys new ideas, something that you weren't thinking about before. I've previously, found it very difficult to do pairs trading in options. So this is a way for you to kind of take a look at some relationships, take a look in this particular environment. If you think the market's going to go down, do you want to be completely out of the market right now? Or do you want to try to generate some alpha by going long one particular area and short another particular area? So I think this is a good particular strategy in this environment. If we do start to go down, I think a trade like this will work. Same thing with the GLD and the SPY trade. I think that trade will also work. So I'm tilting, my emphasis is a little bit bearish in both of the two trade examples that I'm using. So you can do this, the opposite way. You can also do, I was also looking at going long TLT and short SPY. It didn't set up exactly as nice as it did for these particular two trades in the technicals. So again, the net premium cost of doing something like this is much cheaper, $1.40 with this limited risk reversals versus $5.80 if you just wanted to go long AGN by buying calls, and going short XBI by buying puts. That would have cost you $5.80 using the spread versions in it, not even going long outright. So again, I'm using out of the money for these. I'm giving myself a little bit of room. So, it is costing me some money to put this trade on because I'm giving myself a little bit of a buffer. And you can reduce that cost further by going more in the money, especially on the side that you're selling. The risk of this is that AGN sells off and XBI rallies. Again, with these particular trades, the first time that you're doing them, try one out. You don't have to go out to January. The advantage of going out to January with this type of structure is you have some flexibility. If the trade works, great. If not, if it doesn't work, you can buy yourself time. You could also do you can make this even more complicated. You can calendarize a position by selling front month against it, which I'm not going to get into. That gets crazy for this type of example. So any questions? That's pretty much it. We're about 50 minutes. I wanted to open this up to questions. We can go over, any type of example or questions about the limited risk reversal, the structure of it, and so forth. Your short target, do I pair it long Home Depot? Well, I mean, you have to think of a fundamental reason why you want to do a pair trade. You want to capture outperformance. I can't really comment on shorting Target versus long Home Depot. If your belief is that you think Home Depot is going to outperform over the time of your contract, and you think Target is going to go down, that could be one way you could do it. If you have specific catalyst events that you think for those two stocks, sure, you can do something like that. If you are going short Target and you think Target is going to fall greater than the sector, then you can essentially go long consumer discretionary, or you can go long retail via the ETF. Going back to the catalyst, I think, of course, hindsight is 2020, but you can see that, there's definitely some type of shift going on in consumer behavior. The consumer seems to be buying more things on the internet versus department stores. That is why that trade has worked out. Amazon has continued to climb, while retail has continued to sink. So this is year to date. If you look at this over the last month, so that's a particular catalyst. So you want to have that in mind. You don't just want to be playing one thing versus another, just to kind of pair the things together because they're in the same industry. You want to look for a catalyst why one thing is going to outperform the other. So Harrison says, I don't get, so let's go through, the best way to kind of go through for me to answer your question is to go through an example. Let's talk about the GLD. This one gets a little bit more complicated because you're doing call spreads and call puts. Let's talk about this one. Harrison says, I don't get it. I don't get you're selling the same month short while buying a higher strike. So again, remember what risk reversal is. You're essentially you're replicating a long position by by using options through risk reversal is using options to essentially replicate a long stock position. So you're buying calls in one thing and you're selling puts. That gives you the structure of, again, unlimited upside. You're going to, if the stock goes up, you're going to make money on your calls. If the stock goes down, you're going to lose money on your puts because you're short puts. The other thing that will happen is if the stock goes up, not only will you make money on your calls, but you'll also make money because you'll earn the premium from selling the puts. Yeah, absolutely. So again, that is a straight risk reversal. If a bullish risk reversal, again, if the stock, let me just repeat this again. I know it's a little bit confusing. Through a normal bullish risk reversal, your long calls, your short puts. If the stock goes up, you're going to make money on your calls, and you're also going to earn the premium that you collected on the puts. If the stock goes down, you're going to lose the money on your call premium, and you're going to lose money on the put side because you sold puts. If the stock stays exactly where it is, the premium that you collected on the put side is going to offset the cost that you paid for the calls. So looking at the example of GLD, you're replicating that strategy. Instead of that's a risk reversal. The limited risk reversal is you're defining your downside. This way you don't have a huge amount of risk if GLD in this case sells off. You're defining your risk by the width of the put spread, which in this case is $5, subtracted by the premium that you collected, $220. So your risk in that situation is $2.80. And the reason why you're bringing the put spread into the situation is you're offsetting the premium of the calls. Again, the reason why pair trading is so difficult in the option world is by just buying the calls and buying the puts is going to cost you $13.40. It's too much money. It's too much money to spend. Even if that trade, if the trade doesn't naturally go your way, you have an awful lot to try to claw back this huge expenditure that you're doing by going long and going short the other. So by doing this type of structure, you're reducing your cost from $13.40 to $7. That's the whole reason why you're bringing this dimension of a limited risk reversal. I hope that makes it a little bit more clear. So slightly different subjects, thoughts on the growing tension in the markets of monthly squeeze and SPY, thoughts on 1 year at the money straddle on SPY. My thoughts, we are likely going to an all-time high or test year-term lows, both. Yeah, I mean, that's going to be an expensive trade. Whenever you do that type of a straddle, it's going to cost money, especially when you go out to something like 1 year away. Anytime you buy a straddle, it's going to be a lot of money. Whenever I try to do it, I try to do it for a short-term move and try to spend as little money as possible when I do something like a straddle. One strategy that you can do is you can possibly, buy a call spread and buy a put spread. That would lower the premium on something like that. I don't know if diagonalize is a word, but I understand what you're saying. Yeah, you can definitely, or you can calendarize it, which I think is a similar type of word. So that's what I would suggest, Rick, is to offset that, maybe do spreads and something like that. I think that would definitely offset the cost. That's going to be a tricky endeavor, though. I was looking at how much SPY puts. These are out of the money. These are $8. So, that is a pretty expensive trade. Yeah. So Rob says I want to I want to hijack the conversation and take it back to the fund flows, like we discussed over the weekend. It seems like from what I'm seeing, they aren't a leading indicator of a future move. Okay. So excellent question. So this was the fund flows going into utilities. So we could examine this. This took place. The fund flows happened. Let me just zoom in here. First 2 weeks of February was the activity in FXU. So what was the performance of FXU? Call it what? February 7. Let's use mid-February. Fair enough. You want me to use a different time frame? So that's when we first started to see inflows going into utilities. The end of January to it got heightened right around, I'd say, February 15th. Let's call it 18th. So performance of this particular ETF was 7%. So 7%, not bad. What did SPY do over that time frame? Probably did a little bit better. Not the same. Let's look at GLD. That was a big trend that I saw this year. Inflows started in January and have continued. So, if you caught this trend in the beginning of the year, let's say you started to notice this money going into gold. Let's say you caught it at the end of when I started talking about it was the beginning of January. Talked about it all January and February. Let's take a look at the price of gold. Let's call it mid January. 17%. So pretty nice return by picking up the inflows going into GLD. So I think that's, this is a pretty good example. We've seen that carry through. But, if you remember, I've been talking about that. If you can look on my Twitter page, you can go back to January. I've been talking about massive inflows into GLD. I think I started talking about that in December. That was the first trade I put on. I also like to use this in conjunction with option flow. So if we start to see GLD inflows going into gold and I see options going up, I see, call options going up all over the place, and reinforces to me that, hey, they're speculating. You got to remember with option flow, you don't always know what they're doing. You don't know what their position is. You could say, your hope that they're speculating, but you never know if they're hedging. If I happen to see GLD inflows and I see GLD call options going up, hey, tells me that most likely they're speculating because I see money going into both places. This happened. Let me just zoom in a little bit. The outflow started in the beginning of January in FBT. So let's look at this kind of when this started, when we would have picked up on this. Look at it February 2nd, I guess. Oops. Again, you probably would have, you would have picked up on this earlier. I mean, this underperformed. So if you would have done this trade, FBT is up 2%. Utilities up, what do we say, 7-8%? And again, we're looking at this completely in hindsight. I'm looking at this as soon as it occurs. So I'm picking up on this, pretty early. I started looking, just to be fair, I started looking at this once they already started taking a good chunk off of here. But you know, you couple this with if you start to see big put options in IBB and XBI, just kind of reinforces my view. My screen is frozen. Sorry about that, guys. Give me 1 second. So I just want to get the screen unfrozen. If I shut down the application, you're going to have to come back in if it fails. But I think you'll be okay in here. So give me 2 seconds. If by chance the application closes, you're just going to have to come back in. But I hope that won't happen. So I'll be right back. All right, that seemed to work. Yeah, and so the other thing that to talk about with fund flows is, it gives a sense. It gives a sense of sentiment. If there's $15 billion, if there hasn't been any major equity outflows all year long, and then all of a sudden in a matter of 2 weeks, $15 billion comes out of equities. Does that give you a warm and fuzzy feeling? Does that tell you that sentiment, is there a change in sentiment if people really start unwinding equity ETFs? Sure. It's kind of the same. It's almost not the same, but a similar concept with watching unusual option activity. Once you start seeing people take a whole bunch of positions in bearish positions in biotech names, whether it be through the ETF, whether it be through, you're essentially following the money. You're following what people are, where institutions are laying money. Where they're stacking their chips. It's the same thing with fund flows. You're just doing this. You're watching what the cash market is doing, and I don't look at this in particular for why I looked at funds like FBT, why I looked at funds like FXU, why I looked at funds like GLD is because those are not funds that those are not ETFs that people are using as hedges. Those are funds that investment funds are using as their alpha. That has changed considerably in the last 10 years, where originally hedge funds were using ETFs solely as hedges. But being that there's so many different areas of ETFs that you can get into, there are what's known as registered investment advisors that are now using ETFs for asset allocation models. It's much easier sometimes to trade things like EEM or FXI or EZU. It's much easier to get exposure to Europe emerging markets using ETFs than single names. So anyway, that's the thought process on analyzing these flows. Same thing with EM. We saw about 9 straight weeks of inflows into, which I have that up here as well. So about 9 straight weeks of inflows into emerging markets, something that we hadn't seen at all probably in the last 3 years. What happened to this ratio between EM and SPY? It really started to pick up from the lows. If you go from January to when we started to see those inflows, EEM versus SPY really outperformed. So I hope that answers your more of an in-depth question, about why I look at fund flows. To pick up to see what investment managers are doing. Cool. So any other questions? Any other questions about any of the subjects that we covered tonight? Pairs trading, why I'm looking at pairs trading, why I think it's good in this market, any of the structures. We kind of covered a lot in this. If you're not a member of Tribeca Trade Group, these are things that we, will put to work some of these trading ideas, as well as, some of the concepts that I talked about in the beginning of the presentation. I talked about which particular areas that I'm focused on. I use and what we do in the trading room is kind of have an idea before we see unusual option activity. I never just like to straight follow unusual option activity. Why I don't like to do that is because who's executing these trades? Most of the time it's hedge funds. How has hedge fund performance been over the last year? It's been absolutely atrocious. You see fund after fund returning money to investors. You see this, obviously Pershing Square has been in the headlines, but you see, other funds that have very reputable investment managers like Tudor. They've been returning money. More Capital has been returning money. So it's been a very difficult market out there. So that's why I don't like to follow. I know I have a couple other competitors in the business who will just follow straight unusual option activity. I don't like to do that. I like to have a good basis for a good feel for the technicals. Already a good feel for what sectors, what groups I want to go into, so that when I see the unusual option activity, I don't need to hesitate. I can go right into the particular trade because I've done my preparation and I've done my homework. I know what areas of the market that I want to be in. So question, what is limited risk reversal? So you're taking the concept of a risk reversal, essentially a bull risk reversal, again, is going long a call, short a put. I don't like having that much risk of going short a put. So a limited risk reversal is you are buying a call and you're selling a put spread. You're defining your risk to the downside. So you still have risk, but it's a lot more limited. The webinar is being recorded, absolutely. Okay, so what I want to talk about, if there's no more questions, if you're not already a member of the Tribeca Trade Group, I think you have to check it out. If you're a full-time trader, there's a great package to be in our room. You can check it out for 2 weeks free. There's a, hello. There's a charge of just $9.99, as I have to charge you something. But you can cancel this at any time. You don't even have to inform me on our website. So you can go to tribecatradegroup.com and you can check out our trading room. What is our trading room about? Just as I mentioned, we combine option activity with technical analysis. I also throw my own spin of looking at fund flows every day, just to kind of gauge a pulse of what fund managers are doing. We include an hour of pre-market analysis. We look at basically every market that's happened. We look at upgrades and downgrades. We looked at particular stock setups. We look at sectors. We look at commodities. What are the major moves that have happened overnight? In our trading room, we are all working together. A lot of times I'll be trading particular things and calling them out, and some of the traders in the rooms will be, trading other things. I think we've been doing that very, very well. And we're trying to all work together as a group and find opportunities. So I don't think you're going to find that in a lot of different places. I will explore a lot of what the traders are trading in the room to see, take a look at their ideas. One of the biggest challenges as a trader that I've always encountered in my institutional career, as well as what I'm doing now, is you only have one set of eyes. There's only so many things that you can watch. So, to work as a team, as a trading desk together is the whole principle of what I'm trying to do with our particular trading room, to get everybody working together just like an institutional trading desk and trying to make money. That's the goal. So we try to arm you guys with as many tools as possible. We provide a daily trading plan. We've got experienced moderators. We also provide newsletters, and if you're not a full-time trader, if you can't be in the room every day, we do provide trade alerts and the newsletters. Yeah, I don't know. We'll have to see how the complaints go with letting Go Trade on the mic. So that's about it. So please get involved. At least try it out for 2 weeks. It costs you $9.99. So if you try it out, you don't like it, so be it. I would be surprised if you try it out and after the 2 weeks find another trading room that is better. So that's my challenge to you. And you can cancel at any time after the 2 weeks. You don't even have to contact me to do that. So most of you who are already members, thank you. I hope you're enjoying it, and I certainly am. And you don't have to listen to me offer this particular product, because most of you have done that. There's also a annual discount as well. If you want to sign up, you can cancel at any time your monthly subscription, and you can go into the annual subscription. We also do things like we have trading contests. So we started that last month. And we'll do this every month. The winner of the trading contest gets a month free. We also have a referral program. Anybody who you refer into the room, you're going to get a month free for doing that. Cool. All right, guys, let me know if there's any other questions. We went an hour and 50 minutes, which is exactly the time frame that I wanted to go, but happy to answer any of your other questions. So please get involved if you haven't already. If you haven't signed up, I know a couple of you guys may not have done that yet officially. All right. Well, thank you everybody for joining me tonight. And again, any questions at all, you can email me. My email is cfromhertz@gmail.com. I'm also available at Twitter, which you can also reach me. All right, guys, have a great night, and I'll see you bright and early tomorrow morning.